money. Money makes the world go round, and it is, for better or worse, the bedrock on which modern society is grounded on. Since its invention, it has made trading more seamless by creating a mostly universal way to facilitate the exchange of goods and services. Societies have long held that cash is king, but nowadays, it does feel a little bit that its days on the throne are numbered. The rise of fintech companies and their digital wallet and banking apps have led the way for developing economies like the Philippines to transition into being a cashless, or at least cash-light society. In recent news, GCash, the country's largest e-wallet and mobile payments provider with over 94 million registered users, is eyeing to raise over $1.5 billion in their upcoming initial public offering or IPO on the Philippine Stock Exchange, potentially making it the largest IPO in the country's history. The UK-based fintech giant Revolut is gearing up to launch local commercial operations, opening up waitlist registration for Filipinos on their app. Payment platform Google Wallet entered the Philippines late last year, with Apple Pay planning the same, targeting an entry sometime in Q3 of 2026. Whether it's the digital banks themselves or the technology providers, their movements have set in place the infrastructure to permanently alter how the country deals with money. With all these happening, it's perhaps wise for us to consider a couple of questions, like, what can we expect as consumers in this landscape? What can we learn from the countries that have made the same transition? And finally, how can we avoid the pitfalls of handing too much control of the financial system to the private sector? I have personally gone cashless for a while now. In 2016, I was an early user of Maya, then called PayMaya, as they were one of the first to offer a prepaid virtual Visa card, one that I could use to finally pay for digital services like Spotify, Netflix, and this really niche airline business simulator game. As I was in high school then, no bank would let me have a credit card, and my parents, thankfully, were very responsible in not giving me an extension card. While it wasn't their main goal, fintech companies would end up opening the floodgates to the whole sector of digital goods and services, making them more easily accessible to a population where only a minority had traditional bank accounts. As the number of users grew, the network effect took over and services like GCash became widely accepted everywhere. This gave more Filipinos the chance to experience the cashless convenience, such as e-wallets eliminating the need to fumble for change when paying at the cash register, saving everyone time and making record tracking and accounting easier. Domestic wire transfer services effectively became obsolete because money transfers within the same e-wallet network were free. The risk of physical theft and robbery was reduced, with your cash being nothing more than numbers in a locked app. E-wallets even managed to encourage building up savings, as most of them had zero minimum maintaining balances, and therefore more accessible to the masses who otherwise couldn't open a traditional bank account due to their relatively high minimum maintaining balances. With all these perks, surely going cashless is the way to go, isn't it? But as anyone who's had to deal with the stress and shame of biting into a 7-Eleven hotdog only for GCash to be down can tell you, going cashless has its drawbacks. Convenience does only exist when the infrastructure to support it works. You would be well aware of this had you experienced the anxiety of needing to pay for something with your Maya app, but the establishment you're in does not have any reception for your phone to get internet, all the while a line having formed behind you, slowly getting frustrated at how long you're taking just to pay for your shawarma. Yes, most e-wallets and digital banks now offer you the option to add a physical debit card precisely for times like these, but you need to remember that not every establishment has a card terminal. Relying on online infrastructure also means that when these companies undertake periodic maintenance for their systems, you are effectively locked out of your funds until they finish. Speaking of locks, while going cashless does protect you from physical theft, you are in turn exposing yourself to digital attacks. As advanced as the security and encryption technology employed by these fintech companies are, they are never 100% impenetrable, being vulnerable to either sophisticated attacks like fake cell towers intercepting your SMS containing one-time passwords to your fintech apps, or the timeless technique of social engineering, getting users to click on fake links where they enter their login information. Another often overlooked downside, at least personally, is that going cashless has also seemed to affect my consumption behavior, such that by not carrying cash, I have limited my purchase decisions to only places that accepted digital payments or credit cards, driving away demand from small businesses that don't have the infrastructure to support cashless payments. These are just the immediate surface-level downsides though. If we aren't careful and thoughtful about navigating the transition to being a cashless society, these fintech forces could turn convenience into control. Interestingly, I got a bit of a first-hand look at what a fintech future looks like in Kenya. In the developing world, Kenya was ahead of the curve in adopting digital wallets, launching a system known as M-Pesa. Originally envisioned as a microfinance platform for making and paying off small loans via SMS, the platform pivoted to being a digital wallet when user testing revealed that they were primarily using the system to send money to distant relatives. This was because, before M-Pesa, some of the only available ways to wire cash was through banks, which was prohibitively expensive, through money postal orders, which was inconvenient through long lines and limited branches, or through public utility vehicles known as matatus, essentially Kenya's jeepneys, which were largely vulnerable to robbery and theft. Development in Kenya was largely concentrated in cities like Nairobi and Mombasa. Therefore, money remittances were a critical need for its people, and this was solved by M-Pesa. At this point, this largely parallels how services like GCash and Maya grew in the country, both initially focusing on domestic remittances. However, where the paths diverge is in how Kenya dealt with the rise of this innovation. In the early days of M-Pesa, banks rightfully recognized that they had competition. To deal with M-Pesa, interest groups for the banking industry lobbied the Kenyan government to conduct an audit of M-Pesa systems, which, while being the right thing to do from a regulatory standpoint, also had the secondary effect of slowing down M-Pesa's rapid growth. In that time though, what the banks failed to do was to develop a successful competing product. To add insult to injury, M-Pesa passed the audits with flying colors, which further strengthened consumer confidence in them, therefore allowing them to take a near monopoly of the mobile payment sector with an 89% market share. The universality of M-Pesa transformed the Kenyan economy, so much so that their cash in circulation or CIC to GDP ratio, an indicator used to roughly measure an economy's reliance on cash, now sits at only 2.1%. For reference, the US, where credit cards are a cultural pillar, still has a ratio of 7.5 to 8.5%. For all its benefits and encouraging economic movement in the country though, Kenya's unique situation of relying on a single fintech provider also makes it have a single point of failure. Any major disruption to M-Pesa has the potential to freeze up to around 880 million USD per day of transactions, creating a cascading disruption to a significant portion of the Kenyan economy that could not afford to take such a hit. M-Pesa's market position also allows it to take control of transaction fees within their system. For now in the Philippines, transfer fees within the same network like GCash to GCash or Maya to Maya are still free. In Kenya, however, M-Pesa charges a fee for all person-to-person transactions, even within M-Pesa. There is a sliding scale to the fee structure, but at worst, for a 101 Kenyan shilling transaction, you will be charged 7 Kenyan shillings, or just under a 7% transfer fee. This is the worst case scenario, and higher transfer amounts do have a proportionally lower fee, but these fees do add up and they demonstrate what happens when a market gets captured by a single dominant player. Perhaps the biggest dilemma with going digital, however, lies in the loss of privacy. I will be doing a separate video on why privacy matters even for law-abiding citizens, but for now, just ask yourself some questions. Would you be comfortable if strangers know how much you're worth? Would you be comfortable if burglars knew how much money you had? Will you ever feel that you received a fair deal if, say, you go and purchase airline tickets, but the airline website knows exactly how much budget you have for it? Even if we assume that digital wallets themselves won't sell or use your data for their advantage, there is a need for us to realize that data breaches are a matter of when and not if, even for the most secure companies around the world. The convenience of cashless inherently requires trading off the anonymity of cash transactions. The Philippines transitioning to a cashless or at least cash-light economy appears inevitable, with the fintech market hot and the government turning up the heat. Despite the disadvantages I've discussed, I actually am excited about the fintech sector in the country. Growth for them means more jobs and more competitive financial products for us consumers. Ultimately, I think that this transition would be a net positive as long as we do it right. What we do need is to keep the powers that these fintech companies have in check and well regulated. The BSP, to their credit, has handled the entry of digital banks and e-wallet products competently. They had the foresight to move early and control the pace of competitors entering the market through their digital banking license system. Their consumer protection helplines do work and are even effective enough such that merely copying their email in a complaint pressures the customer service departments of these fintech companies to come to a quicker resolution. This is the kind of regulation that we want to see and want continued. You may think that we are safe from monopolies now since the market is flooded by competition, but we shouldn't forget that these waters will settle. Many fintech companies in the Philippines right now are in their aggressive growth phase, burning investor capital to capture market share. Some of them have already fallen, like ING in 2022, which, despite being backed by multinational resources, had to exit the market they had a hand in creating. More are sure to fall, and the survivors will one day work to recover all that capital that they've burned to survive, whether it's through raising transaction fees, offering predatory loans, selling our data, or whatever new scheme McKinsey cooks up to reduce costs and increase profits. They will find a way. We as consumers need to let our regulators know that these companies' profits should never come from price gouging the consumer. Thankfully, as I was writing the script, news came out that the BSP has ordered financial institutions to slash their interbank transfer fees. Here's to hoping that they continue on with this momentum. And finally, the most important thing that we have to remember is that these conveniences should never come at the expense of those that can't afford it. Even once we reach a majority adoption of fintech products and their cashless systems, cash should never be fully abandoned to allow those without a smartphone to continue participating in the economy. With all these said, what do I think overall? Well, I think fintech is cool. We just have to remember that with great convenience comes great responsibility.